Hi traders and welcome back. Lockie here. Hope you are magic. Welcome to video number 2. Guys, if you missed video number 1, we were just talking about the fact that you can trade gold in both directions. We're going to be targeting those 4 rules there. Being an easy $200 target, we're going to go to the 80% rule, extreme volume, and finally strong candles. Now, guys, in video number 1, we spoke about the orange candle here, extreme volume. Video number 2, we're going to be talking about the mustard green candle and how you basically deal with it. So this mustard green candle, ladies and gents, that is extreme volume by the buyers. Now, ultimately, that means it doesn't matter how strong that candle is. You're best off not joining the buyers because they've run out of steam. What you want to do is, in fact, join the sellers. Now, I want to draw your attention to this candle here. It's actually quite a strong sell candle, but can everybody see it straight back into a pivot? Right, that's that line running across the screen there. So you've got to be very, very careful. Gold, oil, and currency trading, as they are all very, very hypersensitive to pivot. So what we want to do, I see this really strong 2-rated candle here. What we want to do once again is we're looking to enter outside the range of that candle. So literally enter below the candle there with the intent of going straight to your $200 profit target. Once again, guys, you're going to apply that 80% rule, which is once you are 80% of the way to that target or $160 into profit, you can either reduce your risk, cut your risk off to break even, or lock some profit in so you literally can't lose any money on the trade. So that candle there, guys, very strong candle. Why is it really good fun? You can see the buyers have actually pushed into the market here. They've actually created a higher high when you compare this big candle here to the candle before. So they did create a higher high, but the sellers basically said, nah, we've completely got you guys outflanked with a 2-rated candle. Now, what we've got after that, ladies and gents, in a really interesting response, you've got another trade directly afterwards. Now, let me pull this one apart for you. This little 2-rated candle here, guys and girls, says that the sellers are taking control of the market. One of the most important things you can focus on, guys, regardless of what you trade, be it currencies, oil, gold, or stock indexes, is what we refer to as the response candle. So what is the market's response to your signal set? Now, in this case here, we've got a 2-rated candle, which says, you know what, boom, we're going to go down. We've gone down, we've got our $200 target. Well done. The market's response to your candle is to create an even larger candle, and it's still got a strength rating of 1. What does that mean? You can re-enter another trade if you want underneath that candle for another $200. And what have you done? Guys, hey presto, in around about 3 candles, you've made $400. Now, some of you might not get excited about a $200 profit target. That's okay. That's only per contract. So if you're a 1 contract trader only, that's $200 per contract. If you were a 2 contract trader, you would have been looking at $400 per trade. If you're a 3 contract trader, guys, you would be looking at around about $600 per trade. So this can actually become, guys, quite good quite quickly. Okay, so it can actually be quite good fun. Now, as we move on down the image, ladies and gents, you can see that we've actually got a pivot down the bottom here. So what we want to be very careful of is if we are in a longer range target, we've got to be very careful of trying to trade through this pivot. Now, mind you, once the market closes over the bottom of the pivot, if you want to, you could have actually taken another trade. And there's a great little lesson here, guys and girls, because once again, if you're using a $200 box, that one has gone $190 towards your $200 target. What does that mean? It's triggered your automated risk control. But that brings up a great little lesson, ladies and gents. As I do on all my NASDAQ videos and also my index videos, guys, the gold market is hypersensitive to a Fibonacci extension. So what I'm going to do, I'm going to grab the Fibonacci extension for you. I'm going to follow the most basic Fibonacci principle, which is we cruise the market down to the low and then we cruise back up to the high. Now, these guys are famous for failing, ladies and gents, at the 133 Fib extension, typically the 141.4, and if it's really volatile, the 161.8, all the way down the bottom of the chart there. What does it ultimately mean? As if this is where the gold market normally fails, not only do you want to actually measure the response of the market when they hit that 133 extension, which is to literally go straight back the other way, but also, if you've taken a number of winning gold trades on the way down, is it smart to take another trade all the way down to the bottom of the chart when the sellers may actually run out of steam where they normally run out of steam on a daily basis? Probably not. So what that ultimately means, ladies and gents, is if you use the strength candle, so we've got extreme green volume, so buyer volume, they've lost control of the market. We want to wait for the sellers to prove their strength. We've had 2 trades, both of them have gone through the $200 profit target, and we've applied all of these rules in the little yellow box. Now again, it goes to keep the video as short as what we possibly can. What I'm going to do is I'm going to come back and talk about that pivot-based reversal in the next video. Guys, we've got a classic SBR here, what we call a static bar reversal. So after the sellers have absolutely lost control of the gold market last night, how do we handle the market going back the other way? So let me jump into the next video, ladies and gents, and I'll show you how to handle that static bar reversal going back the other way. So on to the next video.